a lot of emerging market equity boutiques, not to name them here, but they've really struggled. They haven't done well. A number of them have folded.
I think one of UK's senior Conservative politicians was involved in one of them. No.
But essentially, we thought it was also great timing from that perspective because we still think there's a huge need for this kind of approach.
Have you ever wondered what investing in emerging markets is all about? It's complicated, right? And having witnessed a decade or more of US dollar dominance and outperforming developed markets, particularly US markets, why bother looking at the rest of the world? After all, isn't that where all the bad stuff happens, like currency crises and debt defaults? Recently, there are signs that maybe emerging markets might be, re-emerging. This year, there have been signs that the dollar's dominance is maybe not quite so dominant. And following the Fed's decision to cut rates by 50 basis points, China announced its intention to add significant heft to its policy of monetary and fiscal loosening in what is the world's second largest economy. Following an extended period of being considered uninvestable, Chinese equities had a near 30% bounce in just a couple of weeks. Was this some hasty short closing, or was it the reawakening of the biggest of the emerging markets? This is currently one of the fiercest debates among global investors today. I wanted to get the perspective of an emerging markets expert, and so was delighted to have the chance to speak with Leila Kardouche of Variis Partners. Leila is a veteran of the space, and she and her small team have recently launched a new London-based emerging markets partnership, filling the space left by several high-profile investors who have recently left this area due to its long period of disappointing returns. In this episode, we learn about what is the structure of emerging markets, how the benchmark indices such as the MSCI is not very helpful in uncovering the full potential of the growth opportunities often obscured within these markets. Among other things, Leila discusses how to evaluate political risk in this widely diverse range of markets as we take a tour of what's hot and what's not in an investment universe covering 85% of the world's population. Critically, Leila and the Variis team focuses on stock selection, and Leila discusses how the challenges of growing businesses in emerging markets has produced some very successful compounding growth opportunities. And yes, these companies have outperformed strongly, even within markets like China that have been so disappointing overall. As ever, I need to remind you that what you're about to hear is for information purposes only and does not constitute investment advice. The views expressed are purely those of the contributors in a personal capacity and do not represent the views of Progressive Equity or any other organisation mentioned in this podcast. Please enjoy my conversation with Leila Kardouche.
Brought to you by Progressive Equity.
So, Leila, thanks for joining. Can we just start by finding out a bit about you? How did you get into investing, and particularly what drew you into emerging markets?
I have to be completely honest. When I was a student studying at university, I really wasn't that focused on investments. I was actually doing a liberal arts degree here in the UK. But I spent my third year abroad in Paris. I got an internship in a brokerage house, and I worked for the research department. And they had me doing a lot of research jobs. They sent me around town to results presentations. I started, really helping them and supporting them. And I just found that very interesting, that idea that with, an edge, some kind of angle on a stock, some sort of added value. I got a job at Schroders on the graduate training program. Then I joined the following October. When I got there, they put me on the UK equities desk, which was where all the graduates joined. And, that was interesting, but I knew immediately that what I really wanted to do was join the emerging markets desk. And that was, partly my own background. I'm part Middle Eastern, but I just found all the macro politics and all of that sort of additional dimension in emerging markets. I just found that all really exciting. So I lobbied hard. And then sort of within about 6-9 months, they moved me to the emerging markets floor. And it was just fascinating. And within about a year, they had me traveling all over the world. I was sitting in rooms with ministers of finance and central bank governors and CEOs of very large established businesses in emerging markets. And that's sort of really how I fell into it. I was born in Montreal, Canada.
Hence the French.
Hence the French. My mother is an American. My father was half Lebanese, half Palestinian, but was raised in Egypt, in Cairo. And so we went from Montreal to Beirut to Cairo to New York. And then I found myself in London by the age of about 4 in the UK. But yes, I do speak French. And that was quite helpful initially in some of those North African countries. And those were some of the first countries that Schroders got me to work on. If you think back to the 90s, there was an awful lot of opening up and privatization in a lot of these countries. And so we were doing quite a lot of work in that part of the world at that time. I mean, what happened after is another story, but it was very exciting. And I think, Jeremy, that's really what drew me to emerging markets was my background. I felt like I might have an edge,
Sure. Yeah.
Grown up partly in some of the developing world. And I just thought I'd feel more comfortable in that kind of investment backdrop. And I'd have more added value.
Can we get just a few definitions? How do we define emerging markets and how do they differ from developed markets?
It's just an incredibly broad group of countries that have come into a benchmark. But actually, if you think about it, they represent 85% of the world's countries, 85% of the world's population, roughly, but more like 50% of the world's stock market. So that's kind of the imbalance, as it were, this idea, the convergence idea over time. But in terms of the underlying countries, they're all incredibly diverse. We named our business Variis. Variis is, in fact, the Latin for diverse, because we think it really captures our universe. Very rarely do we see upgrades from emerging markets into the developed world. For example, ever since I've been doing this, Korea has been a hot topic. Should Korea be upgraded to developed? There are things like access issues in that market, communication, disclosure. And so even though the GDP per capita is incredibly high, comparable to, many European countries, it still falls short. And so it's very rare that you get these upgrades. What you do get is countries coming into emerging markets and then sometimes leaving, but being downgraded. And that's because of capital control issues. I mean, that's happened several times to Argentina, for example.
Yes.
But what I would say is emerging markets, they're all very different from each other. Actually, they're everything but the 10 legacy so-called developed markets. So there are only 10 country markets that are not. And so they've just bundled everything else into this benchmark, as it were. What I should say, Jeremy, is that we're talking about thousands of companies. I think there's about 6,500 companies listed around emerging market exchanges and about 1,500 in that MSCI benchmark that I'm referring to. But we only look at about 150 of those names. And those are the names that we think are very special because of their moats, because of their management, ownership structures. So a lot of that benchmark is not that appealing to us.
Could you just sort of summarize the broad changes in that emerging market landscape over the recent past, over the last few decades?
The very first emerging market equity fund, I believe, was launched in something like 1986, and it was IFC supported or backed, and I think it was Capital Group that launched this first fund. And in fact, my colleague Rufus Fraser, who was at Genesis for a decade, I think their firm then launched a fund just a couple of years later. So early, very early into this. But really, in terms of the scale of assets that was in emerging market equity funds, it was pretty de minimis. It really wasn't until the sort of 1990s that the asset class took off. And what are emerging markets and why did it become a sort of a dominant kind of asset, or let's say relevant asset class? It was kind of post-Cold War, the world was becoming more interconnected, globalization, trade flows. And so this is kind of when the emergence of the asset class began. By the late 1990s, when the asset class was more prominent and was actually in many people's global allocations, we then had the Asia crisis. Yeah. And that was, of course, very, very painful because by that point, people had exposure. And that was the first kind of large scale setback. And then very soon after, we had the Russia default and devaluation, largely led by the Asia crisis because oil prices collapsed.
And then we had LTCM on top of that, that sort of amplified it all for us. Yeah,
exactly. And so that was really a bit of a shocker. But then we had this kind of golden age from around 2001, 2002. And that was this kind of global synchronized growth that we had. China was growing. It was firing on all cylinders. It was sucking in exports for its kind of investment-led growth. And so from about 2001 to up until the global financial crisis, people couldn't have enough of emerging markets.
Yes.
And that's when it became, people were probably over-indexed to it, as it were.
I think that was also the time when we first had the acronym BRICS.
That's correct. In fact, that acronym came out quite early on, I think in the early 2000s. And that was the gentleman at Goldman Sachs who coined that: Brazil, Russia, India, and China.
It sort of captured the zeitgeist. For those of us who aren't in emerging markets, it was a real advert for what was going on in your world at that time, I think.
That's absolutely right. And it was basically the idea of these countries, and they all did different things. Some were consumption-led, some were export-led.
Yeah.
They were all kind of driving each other. And the idea that we would have that convergence of stock markets. I mean, let's be honest, Russia doesn't really, there's no access to Russia anymore. Brazil's growth has been up and down, and its structural reforms have been up and down. China, we know what's going on with China today. I guess India's been the real structural grower over the last several decades, and that's been one of the really exciting stories. It's still an asset class that people have to pay attention to, partly going back to the reasons I mentioned. It's 87% of the world's population.
Yeah.
We can't afford to just write them off as too volatile. And of course, they're all so different and they all offer different exposures. Some of the countries are technology heavy, some are commodities heavy, some are domestic consumption story heavy. So, they all have different things to offer. I guess our view is that it's all about selection.
But just on this sort of historic point as an asset class, that period you describe in the late 90s, early 2000s as the golden age of emerging markets, it was the period where we had supposedly reached the end of history and globalization was in full swing. There was just buckets of investment capital going into China and other advanced emerging countries. Ironically, the BRICS nations, having been sort of corralled together by Goldman Sachs 20 years ago or 15 years ago, are now, so we're told, developing political ties in what could be argued as a response to that globalization trend and the dollarization of the global economy. Is that an issue, or is that just something we just sort of read about in the media?
Clearly, there's a more sort of protectionist wave coming, especially from the West, as they deal with their own domestic issues. But when you look at the actual trade flows and the actual economic data, the emerging markets, including China, very much so China, are still incredibly integrated into the rest of the world. So I think there's a little bit of what we read in the papers and what is actually going on behind the scenes. But, is policy different? Are there more tariffs? Do we need to worry about these things in a way that we didn't have to 10, 15 years ago? Yes, we do. And that's obviously where our analysis and judgment comes in. And, especially when we're looking at a country like China, we have to be very careful what kind of investments we want to make, because we need to understand the degree to which they're politically sensitive, not just US-China relations, but also domestically, whether within China a company is taking into account all its stakeholders, not just shareholders, but employees, local government, and what have you. So it's probably just become a lot more important doing that kind of stakeholder.
It's more nuanced.
It's more nuanced, absolutely.
Yeah.
But, there's still enormous amount of cross-border, and I don't think that's changed that much in terms of exports and what have you.
As investors, or just a private individual who's looking to preserve and grow capital, how do you think they should think about their having exposure to emerging market equities in, a broadly based portfolio?
We have a huge co-investment in our fund. I mean,
I've seen that, yeah.
We're completely aligned, and we think it's a great place to be, particularly after the muted returns over the last decade. But I think if you're an endowment or a pension fund and you're looking at your allocations, without question, you should have exposure to this asset class for all the reasons that we've discussed, the fact that they're represent such a big portion of the planet and that the GDP convergence should over time come through. But I also think that it's simplistic to just look at the last 10 years of pedestrian returns. What you need to do is go back longer than that, maybe 30 years, perhaps to the point where the MSCI emerging markets benchmark was formed. And we can look, and over that period, over a 30 plus year period, you can see that this asset class actually returned close to 200 basis points of excess return over MSCI ACWI, so the rest of the world. And so although the last 10 years we've been in a world post-GFC where there's been very strong dollar, strong US growth, and that's had negative repercussions on emerging markets, I think what we're saying is that we believe strongly in this asset class, and we believe strongly that the trends that we've seen over many, many decades start to reassert themselves. And also it's a great time, given that there's been tremendous dollar strength, given that we're looking at a US interest rate easing cycle, given that the growth differentials between the US and the rest of the world are starting to shift the other way.
No, I can see that. I'm interested that you mentioned the strength of the dollar several times in that answer. It strikes me as sort of simplistically dollar strength bad for the rest of the world, particularly emerging markets, because they've traditionally got dollar debt. Therefore, dollar weakness, which we've seen quite a bit of late. And some people think we might see a lot more of it, particularly if we get a Trump administration later this year, should mean emerging markets very good. I mean, simplistically, am I wrong?
No, you've nailed it.
Okay, that's it. End of interview. Fine.
Absolutely. And we really think we're kind of at a sort of an inflection point for the dollar, regardless of what administration we get coming in the US. I think the policies will be a little bit different, but broadly, we're still looking at an easing cycle. The US coming off a high period of growth, a lower growth environment. And we're also looking at a bunch of emerging markets that over the last 10, 15 years have gotten their houses in order. I mean, you'll remember the taper tantrum in 2012 or 13, I forget now. Yeah. So many mini crises. But as a group of countries, that US debt, FX denominated debt that you referenced, it's fascinating that 2 days ago, the Fed cut 50 basis points, which was actually bigger than what people had thought. And Brazil raised rates on the same day.
Okay, all right.
Remember, they went into the hiking cycle before anyone else.
Correct.
They got the inflation first.
But they got interest rates up to about 14%, I think, didn't they?
They did, but they've come back. They were about 10.25%, I think, and now they've got, or 10.5%. They've gone up to 10.75%. So they only did a very small rate hike. But the signaling is we're on top of this inflation, and we are an independent institution, because there's some concern around Lula putting his people there. But I think very much these governments and these central banks around emerging markets know that they have to have teeth, and they do have teeth. So I found it fascinating that they did it the day the Fed cut. So what does that mean? That means the interest rate differential widens 75 basis points. Brazilian reais strengthens significantly over the last sort of 24, 48 hours.
Okay.
That draws people to Brazilian assets. not just because of the carry trade, because it gives people confidence in these institutions and their ability to fight inflation and have a very, very focused mandate. These are not political institutions. And that's, something that gives so much credibility to emerging markets.
As I understand it, you've got a universe of 6,000 odd highly differentiated companies in a large number of highly differentiated countries in different parts of the world. And you're trying to sift that to a sort of watch list of 120, 130 names from which you then construct your portfolio. So the degree of screening involved in your process is immense. Can you just talk us through it?
So you're quite right, between 6,000 and 7,000 companies, of which 14 or 1,500 make it into the benchmark. And by the way, we don't think too much about benchmark. We're very happy to go off benchmark. We invest in a lot of great companies in emerging markets that aren't in that benchmark. That benchmark isn't necessarily the best reflection of the opportunity set. But nevertheless, we do have to screen and take a big haircut. And the way we do that is two kind of main ways. One is very quantitative, so liquidity. So many of the companies that we're referencing, that 6,000-7,000 number, they just don't trade, or they're highly illiquid. Now, obviously, for our business, that just doesn't work because this is a sort of scalable, liquid strategy. So that already takes out the vast, vast majority. So these are companies that simply aren't trading. They're trading below $10 million a day.
And that's your threshold, is it?
That's our threshold.
Yeah,
somewhere between $10 and $15 million. Obviously, if something's incredibly exciting and we think there's a liquidity event coming and it's trading 8 million, we don't want to be absolutely purist about it. There's some artistry in it. But the next phase of getting to our 120 name focus list is a lot more subjective. And that really is our experience, in my case, almost 30 years, my colleagues, 20 plus years. That's our experience of knowing those companies and understanding the history, the track record, the management, the quality of those businesses, the moats, how moated are those businesses, the sort of longevity, looking at this idea of stakeholder. Does this company serve all its stakeholders? Is it potentially under scrutiny from regulators or what have you? And then we don't invest in cyclical businesses. So immediately that removes a chunk of exposure. So we don't invest in energy. We don't invest in mining. These are businesses where we have no real edge. They're more like macro bets, and we're not really macro people. And if you look over the long cycle, these are not businesses that really deliver shareholder value. The other segment that we don't invest in is the state-owned enterprises, government-owned businesses. And that is really because they're not there to serve shareholders or all stakeholders. They have a dual mission. Often they're tools of the government, whether it's directed lending if it's a bank or if it's a commodity business, to do perhaps value-destroying projects. So that also eliminates a chunk.
How do you assess for political risk, and how do you take account of political risk in your framework?
One answer to that is just we've been at this for a very, very long time.
Yeah.
And we've built up strong views from country to country, rule of law, governance, macro stability. And so we just have our own opinions from country to country. But we also, of course, rely on external research. We look at political risk rankings. We look at macro risk rankings. And the idea is really to make sure that our portfolio is very diversified, does not have too much risk in any one jurisdiction. And what you'll find is that focus list of 120 names has gone through rigorous assessment as to whether there are any political risks either in the country or with that specific business. Is it doing something sensitive? And then if we think it's risky or there's a risk of government intervention, we just put it up, we take it off the focus list. And so that 120 names has already been massively de-risked.
So you've got industry sectors that you've talked about that are off limits, but sounds like you've got countries that are off limits as well. But presumably, whereas the industrial off limits, sector off limits don't change so much, the country off limits could change if political circumstances change.
Yeah, that's right. At the moment, I think there's like 24 countries in the index. We would invest in most of them, assuming the actual company and the sector that we're investing in, makes sense. But we're also happy to go into countries that are not in the index if we feel those are good, stable environments. A lot of people will ask us, well, why don't you revisit Argentina? I mean, that's quite a topical one.
I wanted to ask you about Argentina, yeah.
And I guess this is where experience comes in. Decades of seeing Argentina.
Is it different this time?
Well, that's it. We thought it might be different last time with Mr. Macri, but that all ended, and Mr. Milei is evidently trying to tackle the big fiscal problem that Argentina has. But, unfortunately, these things can be very unpopular. And then before you combat your island, these governments are out. We would not go into Argentina at this juncture. We would have to see a much more kind of stable backdrop. We might have Argentinian exposure through another company.
Listed in a different country.
Yeah. So there's this wonderful company, Mercado Libre, which is e-commerce giant in Latin America. Yeah. Their origins are, in fact, Argentina, but it became such a dysfunctional place that, they had to expand in Brazil and Mexico and so forth. So they still have a very successful business in Argentina, but it's kind of been mothballed because of the economic instability. But we do have exposure to it indirectly, but we would never go in at this early stage of the story, knowing that they could all end in tears in 6 months.
Okay.
We're buying businesses on a 3 to 5 year view. We're trying to select 20 to 25 amazing companies that we can sleep at night well, knowing that we own these businesses. And you just can't do that in a place like Argentina at this point. So that can, of course, change in time.
Let's talk about some other countries then.
You can sometimes be seduced. There's a great example of Nigeria where everybody got very excited about Nigeria in 2005 and 6 and 7 because the valuations were so cheap. And actually you'd meet these companies and they were terrific, so well run. But there's a reason why they're cheap. You can't get your capital out because the Naira needs to devalue every year because of all sorts of things. So I think having had many of these experiences over 20, 30 years, we know not to be seduced by what looks like great value.
It's really interesting, this, because there's so many parallels between your process of picking countries or jurisdictions to those of us in UK equities or in small cap investing in terms of picking companies.
We just have to really have a very high degree of scrutiny. So whenever there is some kind of shift in political economic management, we're not fast money. We also have a huge amount of our own liquid net worth in this fund. And so we want to make money, but also preserve capital.
Preserve, yeah, absolutely.
So we're not going to run into Argentina because this guy has said a couple of interesting things. We're going to take our time and analyze and see whether this has legs.
Can you give us just one or two other examples of companies that can sort of illustrate how such great quality businesses are out there in the emerging market world that perhaps us people who just look at developed markets won't be aware of?
There's another great business that we own. It's actually listed in the US, but it's really a Brazilian company. It's called Nubank, and it's a digital bank. And I think these are interesting stories because these are companies that have been able to thrive despite pretty bad macro backdrops over 10, 15 years. So these are disruptive businesses that have come in and taken share from traditional suppliers of services, be it financial services or retail services. But in the case of Nubank, this is a business that's been around for over 10 years. As I said, the roots are in Brazil. And what they saw was an opportunity to disrupt this very oligopolistic banking system in Brazil, dominated really by 3-4 banks, very high fees, very high loan rates. And they felt if we could come in and if we can get our underwriting models, because obviously with banking, you need to know how to lend. You need to understand what the credit risk is. But if we can get these underwriting models in good shape and we can start charging people less for credit, and if we can really create a sort of an exciting financial inclusion story, we can take share from these incumbents and create a whole new market. And we don't need the legacy branch network, which all those banks have. So it took them about a decade. They did their IPO in 2021, I believe, December 2021. This was just as rates were starting to go up and all those growth multiples contracted. So they came at a terrible time. And then the shares fell a lot from the IPO all the way through the next year. But it was very much always on my radar because it's such a high quality business. We just wanted to see if they could get through a difficult credit cycle. And that's when, as you rightly pointed out earlier, Brazilian rates shot up to 14%. We wanted to understand, are those models robust? Can this business really underwrite? What is the NPL ratio really going to look like at the other end of this? And they really demonstrated not just their scalability and their operating leverage, but they really knew what they were doing and they really had a sort of secret sauce, as it were. So when we launched the fund last October, so we're coming up to almost a year now, it was one of the first names that we put into the portfolio on day one. And it's already doubled since then. I guess the question is, where's fair value? They're now rolling out the same model in Mexico. So that's another whole leg of growth. I think it's interesting that they refuse to go into Argentina. When they go into Argentina, I'll go into Argentina.
Okay.
So again, this is a business that has incredibly, high quality management, founder led. The founder is still the CEO.
I like those kind of businesses.
Yeah, just very aligned and has multiple levers of growth. So they're not just doing credit cards, they're now doing what they call payroll loans, which are very secure. They're going to more transactional banking. They're offering insurance services, and they're doing all of this at very attractive price point. And what's exciting is that the regulators love these guys because credit prices have fallen.
They're expanding the market.
They're expanding the market.
Yeah.
These guys are music to their ears because they're facilitating financial inclusion. They're lending to people that never were lent to before by the incumbents. And so it's really win-win for everybody, except, of course, the incumbent banks. They're seeing their fees erode and they're seeing pressure on their asset yields.
You think the regulator is encouraging of them and supporting them in terms of lending money to people in lower socioeconomic groupings, because in the UK, the regulator seems to be highly restrictive on any business that is lending to people who I think 15 years ago we would have called subprime.
I think we're just so early in that sort of story of financial inclusion. I mean, these are people who are getting, $20 credit facilities, $50. I mean, I think maybe that discussion will be somewhere down the road. At the moment, the regulator is very much endorsing these guys because of that inclusion. The micro merchants for the first time can transact or have payments methods, digital payments. And this has been, I think, very positive for the economy and for the unbanked, as it were. Down the road, there could be an issue, but household debt is just another level of what it is in the West, where we have bigger problems.
Can we talk a little bit about China? I've been talking to a lot of people in recent months on this podcast about how and why the UK equity market is so cheap. But actually, when you look at China, I mean, it's off the clock cheap.
So China is sort of the hot topic. The market's done very, very poorly over the last few years. There's this sort of geopolitical pall over the market. Optically, it looks very, very cheap, which you allude to. Maybe if we just tackle that first, I think what you really need to do with China is look under the hood a bit more, because there's a lot of different things going on. That depressed valuation, a lot of it is the fact that we just have a lot of awful companies in the MSCI China. There's some great companies, but there's just a lot of awful companies in that sort of index. And companies like SOEs and...
So politically controlled companies.
Politically controlled, yeah, and very cyclical businesses as well. And these are companies that probably don't deserve high multiples. And there's also been, if you look over the last decade at this terrible Chinese performance, there's been a lot of equity issuance, so very dilutive equity issuance. So that's also put, enormous pressure on the market as well. But there have been some tremendous winners in China at the same time, businesses that have gone up multiple times in that period, businesses that we think are not politically sensitive, that are very domestically focused, that don't have geopolitical risk and don't have domestic political risk because they're providing a valuable service and they're market leaders. They may have some issues temporarily if there's some investigations into supply chain issues or whatever. Maybe their business is on hold for a quarter or two, but basically these are terrific businesses and they've gone up 3, 4, 5 times, over the last 5, 10 years. And so there are things like that. So
an example, maybe?
There's a great business that we own called Center Testing, and they do testing, quality control testing in food and technology and what have you.
Okay, like Intertech in the UK. Maybe.
Exactly right. And this is a business that has, it's a market leader. It's privately owned, so it has, private ownership. It's got a great management team. They've been able to take share year in, year out. The business historically grew 20% a year. It's slowed down recently on some kind of regulation concerns, not about what they do, but about their customers. So, for example, in medical equipment, there's been some kind of investigation. But basically, the service they provide is a service that Chinese companies require, which is, certificate and quality control. And so this is a business that is not sensitive in any way to anybody. It's come down a fair bit very recently, but it's still a company that's gone up 4 or 5 times since its IPO. I mean, it's still a business that's been able to buck the sort of trend. And so these are the kinds of companies that we think look very cheap right now and that we need to be selectively, thinking about adding to things like this. So we're not shutting out the noise. We understand why people are worried about China. We completely get it. We're pragmatic about it. But we also think there are opportunities. And so if you do this work, if you do your analysis, if you do the stakeholder overlay, if you think about the potential risk of a business, and, we still think there are things to do. Now, China is a big chunk of the index. I think it's close to 25%. We don't hold, anywhere near that amount, but we do have 3 or 4 names, or maybe 4 or 5 names of the 26 or 27 that we own today. So we do have a few names, but we have a very strong investment case for each one of them. We don't think they're risky in any way. Taiwan's an interesting one because that's one of the risks that comes up with China, the risk of invasion. Now, Taiwan's a very different market. It's very technology heavy. Basically, half of that country is TSMC, which is one of these incredible businesses in emerging markets. It's just a fantastic quality business. But of course, the question is, well, what happens if China decides to go in there one day? And if you look at the Taiwanese 10-year bond yield yielding 1.5%, market clearly not pricing that in. These are legitimate questions, but I think the reality is that if that does happen, we've got big problems all over the world and global equity markets all over the world. We are never over-indexed to any particular market. We're very diversified. I'm not saying we know it will never happen. We're simply saying we don't use 1.5% as a cost of equity. A risk-free rate on risk rate.
Yeah.
We use a much higher discount rate for Taiwanese companies, as we do for Chinese companies, as we do for most emerging market companies. And, that will never capture those black swans. It will never capture them. So I think the idea is to be well diversified, holding really good businesses, and just pray that that never happens.
That makes sense. Let's come on and talk a bit now about your business. This is a new emerging market investment partnership in London. Why now? Why do you need to launch a new business investing in this space? And you've talked about your experience and clearly very passionate about your subject, but can you just define what your edge is and how you keep that edge?
Yeah. So maybe just why now? And then I can maybe touch on the edge. But why now? I mean, I think when the 4 of us came together, so there are 3 investment partners and then our partner who's responsible for all things non-investment. But when we came together, I think we all recognized that from a timing perspective, this was a great time, to the extent that this asset class has had a poor decade, that we had sort of high level views that perhaps the dollar would start to sort of drift a bit. We're not calling for some kind of bear market for the dollar, but we're certainly saying that this is a much better environment than, say, 4 or 5 years ago. I think that's the first case. We were all at a stage where we built up some wealth that we could do this. You asked me, why are you doing it now? Well, truthfully, I wish I could have done it earlier, but sometimes you can, and you just have to wait for your opportunity. So we were all at that point financially that we could do this. We have the runway to do this and see it through. So timing was one issue. The other thing is that, a lot of emerging market equity boutiques, not to name them here, but they've really struggled. They haven't done well. A number of them have folded.
I think one of UK's senior Conservative politicians was involved in one of them.
Not to mention.
No.
But essentially, we thought it was also great timing from that perspective, because we still think there's a huge need for this kind of approach. A lot of the emerging market equity money is run by these giant groups, the BlackRocks, the what have you, and they've just become so big and unwieldy, and returns have been pedestrian because they're all kind of the benchmark effectively.
Okay.
And so we thought, well, we're completely benchmark agnostic. We're coming in with a highly concentrated approach, best ideas across this very diversified EM landscape, a quality bias, which we know, because we've been doing this 20, 30 years, we know that's the only thing that works in emerging markets, is to back great businesses and hold them for the long run. Also, this idea of being completely founder-owned, this huge co-investment, this kind of a bit of a sustainability, or let's say stakeholder lens, all of that really resonates with allocators. That's all very important. Not least of all that, we are female majority owned, which is nice because there's less than 1% of money out of the US I think there's some analysis done that something like 1.5% of the $70 trillion of assets in the US is run by women or, minorities. So, that's a unique proposition. 100% founder owned, female majority owned, massive co-investment, huge alignment, great track records, from the team. I think it's a winning formula.
That's very much a statement of intent. And just in terms of your structure, highly differentiated. I guess a follow-up to that is you and your team, your fellow partners have got successful backgrounds in a wide variety of other investment houses looking at emerging markets. Are you cherry picking the best of what you've learned from each of them, or are you driven more by, we're not doing it that way, we need to do it a wholly different way?
In my case, I started at Schroders and did a decade there, but then I moved into long short investing. And so that's, I think framed a lot of how we think about risk management and self-discipline, technicals, not that we're technical investors at all, but we look at other market participants, and that's been very helpful in, how we trade positions. And then Rufus, was one of the best sort of boutique emerging market success stories. And so that was a multi-PM structure. He's helped us think about how we structure that multi-PM process to really make it effective. So it's taking the experiences of being at these great places, finessing some of those processes, and really making it even better than what our individual experiences has been historically.
What are the main challenges that you face for your business in the next few years as you see it?
The most important thing I would say is that we want like-minded investors or allocators. We want people who share our vision of what emerging market equity investing should be. So that is the time frame, the holding period, the concentration, the approach, the quality bias. We want to attract investors who really buy into that, because I think having great investors is a very underrated thing. It's a real advantage to bring in the right kind of people. And who do we see as the right kind of people? I think it's fair to say that the US market has always been a great place for emerging markets. They've always kind of understood it very well, maybe because of their proximity to Latin America. But a lot of the pension funds and endowments and family offices, they've always had, exposure to the asset class. And so we think that should be our main kind of pool of capital, is those kinds of businesses. I think it's more difficult here in the UK. Equity exposures come down a lot, define, pension fund shifts and defined contribution, what have you. It's just a much more difficult environment. We are only going after professional investors from a regulatory standpoint.
What scale of AUM can this strategy grow to? What's possible and what's your ambition?
The real challenge, is scaling over a certain period of time, like to make it interesting and attractive. But even that's not around the corner. We have a number of years before we say, look, this hasn't scaled or what have you. You'll recall that I mentioned those liquidity constraints. And one of the reasons that we're being, very specific about that is because we do want this to scale. We think it's a scalable product. And so we're running the portfolio today as if we could run 5 billion of AUM. So I think the answer is at today's kind of liquidity and given the stocks that we own today, we could run a $5 billion portfolio. I think what we would definitely do is at around 2 to 3 billion pause and assess. I think one of the questions is, will we have more in mid cap in a few years versus larger cap? And if that's the case, maybe our capacity isn't 5, maybe it's 3.5. It's a little bit of a moving target, but the portfolio today could be run at 5 billion. And because one of the things you don't want to do is create a track record on a portfolio you could never scale. And we've seen that before, and people can see through that.
That makes a lot of sense. What are the particular challenges of being a female controlled partnership? What are the opportunities that presents, and what are the challenges that present?
I think the challenge was actually just getting to this point, right?
Yes, yeah.
Because the whole thing has been a challenge, but now it's no longer a challenge. But yeah, I think just getting here was hard because, all the places that I've worked have been very dominated by men. The challenges have been leading up to this point. Now we've broken through and we've set this wonderful company up. We hope it's going to be a positive because this idea that 1% of assets is run by women is ridiculous.
Yeah.
We know that women are terrific investors. The data is there to prove it. They're good with risk. They're good with sizing. The data only suggests they're as good as, if not better. But putting that aside, there are a lot of endowments and pension funds where, they want to see more women at the table. Whether or not that's going to help us in a very positive way, it's unclear. I hope we're just judged as investors and, not as women. And I know that we have to deliver excellent performance. And that's really all we're focused on.
Maybe we could just finish on that point. So usually I ask sort of a reflective, hopefully not too corny question to finish off these sort of interviews. But I think in this case, it's very pertinent. Any women out there who are thinking about future careers, maybe looking at fund management, and possibly even emerging markets, what particular advice would you give them?
I definitely think it's a wonderful career for women. It's thoughtful. It's not like investment banking, which is very deal driven. And I don't think terribly, appealing, not even for men probably. But for women, investment management is a fabulous career. I would say that long only investing in particular is fabulous. I did it the hard way and spent almost 2 decades in long short.
Carry the scars.
Made me very tough indeed.
Yeah.
But it needn't be quite that tough. And I would encourage them to just really consider it as a career. And then when the time is right, if they get to that stage, setting up an investment firm is very doable. It's not easy. You have to obviously build the track record. But boy, has this been, incredibly rewarding these last couple of years setting this up. It's just a whole nother level of excitement and joy to own your business, to own your destiny, and also to live and breathe it in a way, even more so because you have all your money in it, both the working capital of the business, but also in the strategy. It's just incredibly rewarding. But even if you don't set up your own business, which is quite intense, just working in the industry is fabulous.
The thing I found in my corner of financial markets, the most fulfilling bit is you get to talk to and interact with some of the cleverest people in the world.
Yeah, no, I was blown away. I think I was 23 or maybe 24 when they sent me off. And initially it was, as I mentioned earlier, North Africa. Then they sent me to Turkey. Then I went to Russia. And as you said, I was sitting in rooms with, incredibly brilliant people, not always nice people, but. And that's when I realized, how lucky am I to be doing this?
it comes down to curiosity and developing an understanding of how the world actually works rather than how we're told the world works, or we might hope the world works. The reality of these situations, as you say, I mean, some of these people who are hugely successful, they're not the most pleasant people in the world. They're not the sort of people you'd probably choose to go and have a pint with, but it is, I think, fascinating. And, I think you've summed it up brilliantly. So thank you.
It's been a great journey, and, I've enjoyed it tremendously, and it's not over.
No, of course not. No. So thank you for your time today. I've enjoyed hearing about and learning about the case for investing in emerging markets. It's obviously very complex, very nuanced, very challenging, but also very fulfilling. And you're the epitome of being able to demonstrate that. So thank you for your time, and good luck in the future. Good luck in scaling the business. And hopefully we can have a catch up in the not too distant future.
Absolutely. Jeremy, thank you so much. I really enjoyed talking to you. It's been a lot of fun.
Brought to you by Progressive Equity.